Federal Reserve Chairman Ben Bernanke spoke about the history of the central bank he leads and the goal of economic stability. He made his remarks at a conference in Cambridge, Massachusetts.
Thank you. Thank you. Thank you, Jim. Particularly that part about the bibliography. I'm still working on it. Well, I would like previous speakers, I'd like to thank the National Bureau of Economic Research for organizing this conference in recognition of the Federal Reserve's centennial, which we don't know exactly whether it's 1913, 1914, but we know it's happening around now. And I'm glad to be here and have the opportunity to participate in this very interesting conference. In keeping with the spirit of the conference, my remarks today will be primarily historical in nature, but I will leave discussion of current policy to today's question and answer period, and of course, next week I have the particular pleasure of testifying before Congress, and so that'll be another opportunity to discuss these matters. So today, in my remarks, I'd like to discuss the evolution over the past 100 years of three key aspects of Federal Reserve policymaking: the goals of policy, the policy framework, and accountability and communication. The changes over time in these three areas provide a useful perspective, I believe, on how the role and functioning of the Federal Reserve has changed since its founding in 1913, as well as some lessons for the present and for the future. I'll pay particular attention to several key episodes in the Fed's history, all of which have been referred to in various contexts with the modifier great. The Great Experiment of the Federal Reserve's founding, the Great Depression, the Great Inflation and subsequent disinflation, the Great Moderation, and the Great Recession. In the words of one of the authors of the Federal Reserve Act, Robert Latham Owen, the Federal Reserve was established to, quote, provide a means by which periodic panics which shake the American Republic and do it enormous injury shall be stopped. In short, the original goal of the Great Experiment that was the founding of the Fed was the preservation of financial stability. At the time, the standard view of panics was that they were triggered when the needs of business and agriculture for liquid funds outstripped the available supply, as when seasonal plantings or shipments of crops had to be financed, for example, and that panics were further exacerbated by the incentives of banks and private individuals to hoard liquidity during those times. As has been discussed many times today already, the new institution was intended to relieve such strains by providing a, quote, elastic currency, that is, by providing liquidity as needed to individual member banks through the discount window, and the commercial banks, in turn, would then be able to accommodate their customers. Interestingly, although congressional advocates hoped that the creation of the Fed would help prevent future panics, they did not fully embrace the idea that the Fed should help end ongoing panics by serving as lender of last resort, as had been recommended by the British economist and writer Walter Bagehot. Legislators imposed limits on the Federal Reserve's ability to lend in response to panics, for example, by denying non-member banks access to the discount window and by restricting the types of collateral that the Fed could accept. The framework that the Federal Reserve employed in its early years to promote financial stability reflected in large measure the influence of the so-called real bills doctrine, as well as the fact that the United States was on the gold standard. In the framework of the real bills doctrine, the Federal Reserve saw its function as meeting the needs of business for liquidity, consistent with the idea of providing an elastic currency, with the ultimate goal of supporting economic and financial stability. When business activity was increasing, the Federal Reserve helped accommodate the need for credit by supplying liquidity to banks, and when business was contracting and less credit was needed, the Fed reduced the amount of liquidity in the system. As I mentioned, the Federal Reserve pursued this policy approach in the context of the gold standard. Federal Reserve notes were redeemable in gold on demand, and the Fed was required to maintain a gold reserve equal to 40% of its outstanding notes. However, contrary to the principles of an idealized gold standard, the Federal Reserve often took actions to prevent inflows and outflows of gold from being fully translated into changes in the domestic money supply. This practice, together with the size of the U.S. economy, gave the Federal Reserve considerable autonomy in monetary policy, and in particular allowed the Fed to conduct policy according to the real bills doctrine without much hindrance. The policy framework of the Fed's early years has been much criticized in retrospect. Although the gold standard did not appear to have greatly constrained U.S. monetary policy in the years after the Fed's founding, subsequent research has highlighted the extent to which the international gold standard served to destabilize the global economy in the late 1920s and early 1930s. Likewise, economic historians have pointed out that, under the real bills doctrine, the Fed increased the money supply precisely at those times at which business activity and upward pressures on prices were the strongest. That is, monetary policy was pro-cyclical. Thus, the Fed's actions tended to increase rather than decrease the volatility in economic activity and prices. During this early period, the new central bank did make an important addition to its menu of policy tools. Initially, the Fed's main tools were the quantity of its lending through the discount window and the interest rate at which it lent, known as the discount rate. Early on, however, to generate earnings to finance its operations, the Federal Reserve began purchasing government securities in the open market, what came to be known as open market operations. In the early 1920s, Fed officials discovered that these operations affected the supply and cost of bank reserves, and consequently the terms on which banks extended credit to their customers. Subsequently, of course, open market operations became a principal monetary policy tool and one that allowed the Fed to interact with the broader financial markets and not only with banks. I've discussed the original mandate and the policy framework of the early days of the Fed. What about its accountability to the public and its governance? As this audience knows, when the Federal Reserve was established, the question of whether it should be a private or public institution was highly contentious. The compromise solution created a hybrid. The system was headed by a governmentally appointed board, which initially included the Secretary of the Treasury and the Controller of the Currency. But the 12 regional reserve banks were placed under a mixture of public and private oversight, including board members drawn from the private sector, and they were given considerable scope to make policy decisions that applied to their own districts. For example, reserve banks were permitted to set their own discount rates, subject to a minimum set by the board. While the founders of the Federal Reserve hoped that this new institution would provide financial and hence economic stability, the policy framework and the institutional structure would prove inadequate to the challenges that the Fed would soon face. The Great Depression was the Federal Reserve's most difficult test. Tragically, the Fed failed to meet its mandate to maintain financial stability. In particular, although the Fed provided substantial liquidity to the financial system following the 1929 stock market crash, its response to the subsequent banking panics was limited at best. The widespread bank failures and the collapse in money and credit that ensued were major sources of the economic downturn. Bagehot's dictum to lend freely at a penalty rate in the face of panic appeared to have few adherents at the Federal Reserve of that era. Economists have also identified a number of instances from the late 1920s to the early 1930s when Federal Reserve officials, in the face of the sharp economic contraction and financial upheaval, either tightened monetary policy or chose inaction. Some historians trace these policy mistakes to the early death of Benjamin Strong, governor of the Federal Reserve Bank of New York, in 1928, which left the decentralized system without an effective leader. Whether valid or not, this hypothesis raises the interesting question of what intellectual framework an effective leader would have used at the time to develop and justify a more activist monetary policy. The degree to which the gold standard actually constrained U.S. monetary policy during the early 1930s is debated, but the gold standard philosophy clearly did not encourage the sort of highly expansionary policies that were needed. The same can be said for the real bills doctrine, which apparently led policymakers to conclude, on the basis of low nominal interest rates and low borrowings from the Fed, that monetary policy was appropriately supportive and that further actions would be fruitless. Historians have noted the prevalence at the time of yet another counterproductive doctrine, the so-called liquidationist view, that depressions perform a necessary cleansing function. It may be that the Federal Reserve suffered less from lack of leadership in the 1930s than from the lack of an intellectual framework for understanding what was happening and what needed to be done. The Fed's inadequate policy frameworks ultimately collapsed under the weight of economic failures, new ideas, and political developments. The international gold standard was abandoned during the 1930s. The real bills doctrine likewise lost prestige after the disaster of the 1930s. For example, the Banking Act of 1935 instructed the Federal Reserve to use open market operations with consideration of, quote, the general credit situation of the country, and not just to focus narrowly on short-term liquidity needs. The Congress also expanded the Fed's ability to provide credit through the discount window, allowing loans to a broader array of counterparties secured by a broader variety of collateral. The experience of the Great Depression had major ramifications for all three aspects of the Federal Reserve that I'm discussing here: its goals, its policy framework, and its accountability to the public. With respect to goals, the high unemployment of the Depression and the fear that high unemployment would return after World War II elevated the maintenance of full employment as a goal of macroeconomic policy. The Employment Act of 1946 made the promotion of employment a general objective of the federal government. Although the Fed did not have a formal employment goal until the Federal Reserve Reform Act of 1977 codified maximum employment along with stable prices as part of the Fed's so-called dual mandate, earlier legislation nudged the central bank in that direction. For example, legislators described the intent of the Banking Act of 1935 as follows, quote, to increase the ability of the banking system to promote stability of employment and business insofar as this is possible within the scope of monetary action and credit administration. The policy framework to support this new approach reflected the developments of macroeconomic theories, including the work of Knut Wicksell, Irving Fisher, Ralph Hawtrey, Dennis Robertson, and of course John Maynard Keynes, that laid the foundations for understanding how monetary policy could affect real activity and employment and help reduce cyclical fluctuations. At the same time, the Federal Reserve became less focused on its original mandate of preserving financial stability, perhaps in part because it felt it superseded by the creation during the 1930s of the Federal Deposit Insurance Corporation and the Securities and Exchange Commission, along with other reforms intended to make the financial system more stable. In the area of governance and accountability to the public, policymakers also recognized the need for reforms to improve the Federal Reserve's structure and its decision-making. The Banking Act of 1935 simultaneously bolstered the legal independence of the Federal Reserve and provided for stronger central control by the Federal Reserve Board. In particular, the Act created the modern configuration of the Federal Open Market Committee, the FOMC, giving the Board the majority of the votes on the committee, while removing the Secretary of the Treasury and the Controller of the Currency from the Board. In practice, however, the Treasury continued to have considerable sway over monetary policy after 1933, with one economic historian describing the Fed as in the back seat. During World War II, the Federal Reserve used its tools to support the war financing efforts. However, even after the war, Federal Reserve policy remained subject to considerable Treasury influence. It was not until the 1951 accord with the Treasury that the Federal Reserve began to recover genuine independence in setting monetary policy. Once the Federal Reserve regained its policy independence, its goals centered on the price stability and employment objectives laid out in the Employment Act of 1946. In the early post-war decades, the Fed used open market operations and the discount rate to influence short-term market interest rates, and the federal funds rate gradually emerged as the preferred operating target. Low and stable inflation was achieved for most of the 1950s and early 1960s. However, beginning in the mid-1960s, inflation began a long climb upward, partly because policymakers proved to be too optimistic about the economy's ability to sustain rapid growth without inflation. Two mechanisms might have mitigated the damage from that mistaken optimism. First, a stronger policy response to inflation, more like that observed in the 1950s, certainly would have helped. Second, Fed policymakers could have reacted to continued high readings on inflation by adopting a more realistic assessment of the country's economic potential. Instead, policymakers chose to emphasize so-called cost push and structural factors as sources of inflation, and saw wage and price setting as having become insensitive to economic slack. This perspective, which contrasted sharply with Milton Friedman's famous dictum that inflation is always and everywhere a monetary phenomenon, led the Fed to support measures such as wage and price controls rather than monetary solutions to address inflation. A further obstacle was the view among many economists that the gains from low inflation did not justify the costs of achieving it. The consequences of the monetary framework of the 1970s were, as you know, 2 bouts of double-digit inflation. Moreover, by the end of the decade, lack of commitment to controlling inflation had clearly resulted in inflation expectations becoming unanchored, with high estimates of trend inflation embedded in longer-term interest rates. As you know, and as we discussed earlier today, under the leadership of Chairman Paul Volcker, the Federal Reserve in 1979 fundamentally changed its approach to ensuring price stability. This change involved an important rethinking on the part of policymakers. By the end of the 1970s, Federal Reserve officials increasingly accepted the view that inflation is a monetary phenomenon, at least in the medium and longer term. They became more alert to the risks of excessive optimism about the economy's potential output, and they placed renewed emphasis on the distinction between real, that is inflation-adjusted, and nominal interest rates. The change in policy framework was initially tied to a change in operating procedures that put greater focus on growth in bank reserves. But the critical change, the willingness to respond more vigorously to inflation, endured even after the Federal Reserve resumed the traditional use of the federal funds rate as its policy instrument. The new regime also reflected an improved understanding of the importance of providing a firm anchor, secured by the credibility of the central bank, for the private sector's inflation expectations. Finally, it entailed a changed view about the dual mandate, in which policymakers regarded achievement of price stability as helping to provide the conditions necessary for sustained maximum employment. Volcker's successful battle against inflation set the stage for the so-called Great Moderation of 1984 to 2007, during which the Fed enjoyed considerable success in achieving both objectives of the dual mandate. Financial stability remained a goal, of course. The Federal Reserve monitored threats to financial stability and responded when the financial system was upset by events such as the 1987 stock market crash and the terrorist attacks of 2001. More routinely, it shared supervisory duties with other banking agencies. Nevertheless, for the most part, financial stability did not figure prominently in monetary policy discussions during these years. In retrospect, it is clear that macroeconomists, both inside and outside central banks, relied too heavily during that period on variants of the so-called Modigliani-Miller theorem, an implication of which is that the details of the structure of the financial system can be ignored when analyzing the broader behavior of the economy. An important development of the Great Moderation was the increasing emphasis in central banks around the world on communication and transparency, as economists and policymakers reached consensus on the value of communication in attaining monetary policy objectives. Federal Reserve officials, like those at other central banks, had traditionally been highly guarded in their public pronouncements. They believed, for example, that the ability to take markets by surprise was important for influencing financial conditions. Thus, although Fed policymakers of the 1980s and early 1990s had become somewhat more explicit about policy objectives and strategy, the same degree of transparency was not forthcoming on monetary policy decisions and operations. The release of a post-meeting statement by the FOMC, a practice that began in 1994, was therefore an important watershed. Over time, the statement was expanded to include more detailed information about the reason for the policy decision and an indication of the balance of risks. In addition to improving the effectiveness of monetary policy, these developments in communications also enhanced the public accountability of the Federal Reserve. Accountability is, of course, essential for policy independence in a democracy. During this period, economists found considerable evidence that central banks that are afforded policy independence in pursuit of their mandated objectives deliver better economic outcomes. One cannot look back today at the Great Moderation without asking whether the sustained economic stability of that period somehow promoted the excessive risk-taking that followed. The idea that this long period of calm lulled investors, financial firms, and financial regulators into paying insufficient attention to building risks must have some truth in it. I don't think we should conclude, though, that we should therefore not strive to achieve economic stability. Rather, the right conclusion is that even in, or perhaps especially in, stable and prosperous times, monetary policymakers and financial regulators should regard safeguarding financial stability to be of equal importance, indeed a necessary prerequisite for maintaining macroeconomic stability. Macroeconomists and historians will continue to debate the sources of the remarkable economic performance during the Great Moderation. My own view is that the improvements in monetary policy and in monetary policy communication, including, of course, the better management of inflation and the anchoring of inflation expectations, were important reasons for this strong performance. However, we have learned in recent years that while well-managed monetary policy may be necessary for economic stability, it is not sufficient. So, it's been now some 6 years or so since the first signs of the financial crisis appeared in the United States, and we are still working to achieve a full recovery from its effects. What lessons should we take for the future from this experience, particularly in the context of a century of Federal Reserve history? The financial crisis and the ensuing Great Recession reminded us of a lesson that we learned both in the 19th century and during the Depression, but had forgotten to some extent, which is that severe financial instability can do grave damage to the broader economy. The implication is that a central bank must take into account risk to financial stability if it is to help achieve good macroeconomic performance. Today, the Federal Reserve sees its responsibility for the maintenance of financial stability as co-equal with its management for the responsibility for the management of monetary policy, and we have made substantial institutional changes in recognition of this change in goals. In a sense, we have come full circle, back to the original goal of the Federal Reserve of preventing financial panics. How should a central bank enhance financial stability? One means is by assuming the lender of last resort function that Bagehot understood and described 140 years ago, under which the central bank uses its powers to provide liquidity to ease market conditions during periods of panic or incipient panic. The Fed's many liquidity programs played a central role in containing the crisis of 2008 to 2009. However, putting out the fire is not enough. It's also important to foster a financial system that is sufficiently resilient to withstand large financial shocks. Toward that end, the Federal Reserve, together with other regulatory agencies and the Financial Stability Oversight Council, is actively engaged in monitoring financial developments and working to strengthen financial institutions and markets. The reliance on stronger regulation is itself informed by the success of New Deal regulatory reforms, but current reform efforts go even further by working to identify and diffuse risks not only to individual firms, but to the financial system as a whole, an approach known as macroprudential regulation. Financial stability is also linked to monetary policy, though these links are not yet fully understood. Here, the Fed's evolving strategy is to make monitoring, supervision, and regulation the first line of defense against systemic risks. To the extent that risks remain, however, the FOMC strives to incorporate these risks in the cost-benefit analysis applied to all monetary policy actions. What about the monetary policy framework? In general, the Federal Reserve's policy framework today inherits many of the elements put in place during the Great Moderation. These features include the emphasis on preserving the Fed's inflation credibility, which is critical for anchoring inflation expectations, and a balanced approach in pursuing both parts of the Fed's dual mandate in the medium term. We've also continued to increase the transparency of monetary policy. For example, the committee's communications framework now includes a statement of its longer-run goals and monetary policy strategy. In that statement, the committee indicated that it judged that inflation at a rate of 2%, as measured by the annual change in the price index for personal consumption expenditures, is most consistent over the longer run with the FOMC's dual mandate. FOMC participants also regularly provide estimates of the longer-run normal rate of unemployment. Those estimates currently have a central tendency of 5.2 to 6.0%. By helping to anchor longer-term expectations, this transparency gives the Federal Reserve greater flexibility to respond to short-run developments. This framework, which combines short-run policy flexibility with the discipline provided by the announced targets, has been described as constrained discretion. Other communications innovations include early publications of the minutes of the FOMC meetings and quarterly post-meeting press conferences by the chairman. The framework for implementing monetary policy has evolved further in recent years, reflecting both advances in economic thinking and a changing policy environment. Notably, following the ideas of Lars Svensson and others, the FOMC has moved toward a framework that ties policy settings more directly to the economic outlook, a so-called forecast-based approach. In particular, the FOMC has released more detailed statements following its meetings that have related the outlook for policy to prospective economic developments and has introduced regular summaries of the individual economic projections of FOMC participants, including for the target federal funds rate. The provision of additional information about policy plans has helped Fed policymakers deal with the constraint posed by the effective lower bound on short-term interest rates, in particular by offering guidance about how policy will respond to economic developments. The committee has been able to increase policy accommodation even when the short-term interest rate is near zero and cannot be meaningfully reduced further. The committee has also sought to influence interest rates further out on the yield curve, notably through its securities purchases. Other central banks in advanced economies, also confronted with the effective lower bound in short-term interest rates, have taken similar measures. In short, the recent crisis has underscored the need both to strengthen our monetary policy and financial stability frameworks and to better integrate the two. We've made progress on both counts, but more needs to be done. In particular, the complementarities among regulatory and supervisory policies, including macroprudential policy, lender of last resort policy, and standard monetary policy are all increasingly evident. Both research and experience are needed to help the Fed and other central banks develop comprehensive frameworks that incorporate all of these elements. The broader conclusion is what might be described as the overriding lesson of the Federal Reserve's history, that central banking doctrine and practice are never static. We and other central banks around the world will have to continue to work hard to adapt to events, new ideas, and to changes in the economic and financial environment. Thank you.
Thank you very much. Let me just remind the audience that we will have their index cards available. We've already collected some from people. We'll have folks walking through the aisles. If you would like to try to submit a question, please write the question. We'll then try to bring some of those up so we can try to ask what we can. So, Chairman, you indicated your willingness to talk a bit about current situation as well as the 100-year history. So I thought I'd like to start by just asking you a little bit about the last 6 weeks. Last month, you laid out a contingent plan for reducing the pace of asset purchases. A number of pundits have criticized this step, said it was premature for you to discuss the future contingencies at this point. With the benefit of hindsight at this point, would you do anything differently in that regard if you had that step to take again?
Well, thank you for that question. Well, as I said in my remarks, I'm a very big believer, Federal Reserve is a very big believer in transparency and communication. I think transparency in central banking is kind of like truth-telling in everyday life. You got to be consistent about it. You can't be opportunistic about it. I think if you think about the recent developments and the information that we provided to the public about our thinking, I guess I would ask you to consider the counterfactual if we hadn't said anything. The information we provided about, for example, our contingent data-dependent plans for the asset purchase program were actually pretty close to our understanding of what markets expected for that program. But suppose we had said nothing and that time had passed and that market perceptions had drifted away from our own thinking and our own expectations for policy. In addition, during that time, again, in the counterfactual where we don't provide any information, it's very likely that more highly levered risk-taking positions might build up, reflecting, again, some expectation of an infinite asset purchase program. So I guess I would suggest that, notwithstanding some volatility that we've seen in the last 6 weeks, that speaking now and explaining what we're doing may have avoided a much more difficult situation at another time.
Continuing on that theme, the financial markets reacted sharply to some combination of your remarks and the release of the minutes last month. The market seems to have interpreted the combination of those two pieces of information as hawkish news. Would that be the right interpretation to put on those releases?
So let me start with basics here. The Federal Reserve, notwithstanding that not everybody likes it, I think it's good, has a dual mandate. The dual mandate is to pursue maximum employment and price stability. Currently, we have an unemployment rate of 7.6%, which I think, if anything, overstates the health of our labor markets, given participation rates and many other indicators of underemployment and long-term unemployment. So we're not there, obviously, on the maximum employment part of the mandate. On price stability, inflation is now about 1%, which is below our 2% objective. So both sides of our mandate, both the employment side and the inflation side, are saying that we need to be more accommodative. Moreover, the other portion of macroeconomic policy, fiscal policy, is now actually quite restrictive. The CBO estimates that current federal fiscal policy is subtracting 1.5 percentage points or so of growth from the U.S. economy this year. So you put that all together, and I think you can only conclude that highly accommodative monetary policy for the foreseeable future is what's needed in the U.S. economy. Now, how does that relate to recent communications? I think the issue has to do with not so much with the overall accommodation, but rather with the mix of instruments being used to provide that accommodation. The Fed has two instruments that we've been using in the context of interest rates close to the zero lower bound. The first, asset purchases, we have thought about, and I've frequently described as, providing some near-term momentum to the economy. In other words, we have said that we are trying to achieve a substantial improvement in the outlook for the labor market in a context of price stability. We've made progress on that, but we still have further to go. But again, that's the objective of the asset purchases, is to provide near-term momentum to try to get the economy moving forward more quickly. The second tool that we have is our rate policy, short-term interest rates, and associated with that is the forward guidance that we provided to the public about our expectations for when rates might change. And in particular, we said that we will not raise interest rates until, at least until, unemployment hits 6.5%, as long as inflation is well behaved. Again, I think, as I've said before, that 6.5% is a threshold, not a trigger. There will not be an automatic increase in interest rates when unemployment hits 6.5%. Instead, that'll be a time to think about the situation anew. And given, as I said, the weakness of the labor market, the fact that the unemployment rate probably understates the weakness of the labor market, given where inflation is, I would suspect that it may be well some time after we hit 6.5% before rates reach any significant level. So again, the overall message is accommodation. There is some prospective, gradual, and possible change in the mix of instruments, but that shouldn't be confused with the overall thrust of policy, which is highly accommodative.
You know, in that vein, could you comment a bit on the Fed's outlook for the economy? Because there are many who would argue the Fed is actually optimistic at this point relative to many in the private sector.
Well, I think we're somewhat optimistic. Some of the material we've published, the projections and so on, are a little bit more optimistic than some private sector forecasters. But I think a fair viewing of the economy would suggest that there are some positive features out there, some positive developments, but there are also some significant risks that we have to continue to pay close attention to. On the positive side, I think you would want to start with the housing sector, which has been, of course, a major drag on our economy now for quite a few years, and only in the last year or so has it really begun to turn around and show some strength, which has implications both for construction, for related industries, and also for house prices, which affect household balance sheets. Automobiles are also strong, so I take that as evidence, as Alan Blinder said earlier, that monetary policy is working, because those are two of the main channels through which monetary policy affects the economy. I think a second positive factor I would point to is the state of the American household. While there's still obviously many great difficulties, households in the United States have deleveraged quite a bit. Debt and interest burdens are down. Their wealth is up, with house prices and equity prices and other asset prices having increased. Employment gains mean more income, and sentiment is accordingly much higher. So I think we have a somewhat stronger household sector going forward. And then finally, I would just note, maybe not finally, but I would note that the fact that our economy has continued to grow and continue to produce jobs in the face of very strong fiscal headwinds is somewhat encouraging, I think. And there are other factors as well, including reduced fiscal restriction at the state and local level, a relatively strong banking system which is providing more credit, and a variety of other factors. So there are some things, I think, that make the outlook look more positive. But there are also some risks which I think are very important for us as policymakers to look at. First, it's still early to say that we have weathered the fiscal restraint. I think it's very difficult to know how long the lags are between congressional decisions and actual spending and production decisions. So we're going to continue to watch and see whether growth is resilient going forward for the rest of the year. Again, our projections are that there'll be some pickup in growth, but that does depend on overcoming the remainder of the fiscal headwinds. A second point, which is worth stressing, and I see my good friend Jim Bullard is here, is the very low inflation rate. We are all very much committed to defending our inflation target from below as well as from above. Low inflation, I know everyone, it's hard to explain to your uncle, I know, but low inflation is not good for the economy, because very low inflation increases the risks of deflation, which can cause an economy to stagnate. It raises the real cost of investing, and the evidence is that falling and low inflation can be very bad for an economy. So the Federal Reserve is trying to keep inflation close to 2%. We think that there are some transitory factors at work which have brought inflation down a bit more than is fundamentally the case in some sense. We expect inflation to come back up. But if that's not the case, I think we have to say that that would be a good reason to remain accommodative and to try to achieve that objective. And I guess the final thing I would say in terms of risks, of course, is that we have seen some tightening of financial conditions, and that if, as I've said, and as I said in my press conference and other places, that if financial conditions were to tighten to the extent that they jeopardize the achievement of our inflation and employment objectives, then we would have to push back against that. So I think there are some risks now that we have to pay attention to, but I think it's also the case that there are some positive factors that, with some luck, will generate somewhat faster growth and continued improvement in labor market conditions for the remainder of this year and into next year.
I have a question that comes back to the issues around communication and messaging that you talked about. The Fed has introduced a number of new communication tools over the course of your tenure. Are these changes all permanent, or are there some elements of these new tool and communication strategies which are extraordinary policy that reflect the extraordinary times we're in particular dealing with the zero lower bound?
Well, I think most of the things that we've done will likely be permanent. Not, of course, a future committee might decide to make changes to our projections or changes to the way we structure our minutes or other things that that certainly could happen. I think that you know, the definition of price stability and the longer run policy strategy, I'm hopeful that that will be a long-lasting innovation. The communications that are specifically related to the zero lower bound are particularly the forward guidance, where we've tried to provide not targets, not objectives, but rather guideposts to help the markets understand and the public understand, you know, when we expect policy to begin to change. It may be that when we leave the zero lower bound and when the economy is in a more normal configuration, that kind of guidance won't be necessary anymore, because, as was the case prior to the crisis, the markets can just look at the behavior of the Fed and essentially extrapolate that behavior to understand what the Fed is likely to do as the economy evolves. That being said, there may be circumstances where this kind of guidance is helpful, and I just note that we're seeing the Federal Reserve, by the way, was not the first to use this kind of guidance. I just want to be clear that, you know, the Bank of Japan, the Bank of Canada have experimented with these types of ideas as well, and I think it's becoming an international practice that, to various degrees in various places, but I suspect that we'll see its use in some contexts at least going forward. But I don't think it is necessarily a permanent part Federal Reserve policy, precisely because we will be moving away from the zero lower bound, and I hope we'll, you know, in a reasonable period of time, we'll be in a more normal monetary environment.
You know, on that international theme, you talked about the tripartite roles of macroprudential regulation, lender of last resort, and traditional monetary policy. If we look around the globe, the regulatory policies are in some cases done by an organization which is not the central bank. Do you see there as being a strong case for bringing that role inside the central bank, or can you see circumstances in which it works to have the macroprudential part in a distinct organization?
Well, different countries have different kinds of financial structures. As Jean-Claude was saying, Europe and U.S. are different in many ways, et cetera. But as you look around the world, the trend now, of course, is for financial regulatory activities, financial oversight activities to move back into central banks. I mean, that's happening in Europe, that's happening in the UK, it's happening in the United States. And I think there's a good reason for that. One very simple reason is that central banks tend to have the kind of expertise in financial markets and so on that gives them a comparative advantage in addressing some of these issues. There's the fact that the central bank is the lender of last resort, which there's a complementarity between that lender of last resort function and supervision of individual firms. And then I think generally that there is a macroprudential innovation now that there is much more attention being paid to the broader financial system as opposed to the stability of individual institutions alone. We do both. We pay attention, of course, to individual institutions, but we also try to think about the stability of the financial system as a whole. And I think the central bank is uniquely equipped to have that breadth of vision and to think about how that stability of the financial system relates to its other functions, particularly, as you mentioned, lender of last resort and monetary policy. So I think there's a good case for it. There are different institutional arrangements that can be worked out. In the United States, of course, the Fed has got a authority over bank holding companies and systemically important firms, which means we have a pretty good insight into the largest, most systemic firms. But we share supervisory authorities in both banking and in financial markets with a range of other agencies. And of course, we work collaboratively with those agencies, with each agency developing its comparative advantage in a particular part of the system that it's assigned.
A number of years ago, you referred to a savings glut. And today, there are many who think that there is a shortage of safe assets in the global economy. Is that a view that you would agree with? And if you do, is it something that the Fed should or can do anything about?
Well, on the saving glut, I would like to mention that there were a number of speakers today who talked about, going back to Carmen Reinhardt, who talked about the current account and its role in precipitating the crisis. And this was one of the things that was a theme of my commentary before the crisis, which was the idea that the capital inflows that we were seeing, related, of course, to our large trade deficit, but also to the international demand for dollar reserves, was in fact a potentially destabilizing factor, and certainly was, in any case, making financial conditions easier than they otherwise would have been. And done more recent work with co-authors at the Federal Reserve looking at the European-U.S. relationship. Even though there was a much more balanced trade between Europe and the U.S., there were large gross inflows of financial flows from Europe to the United States, which again were a demand for safe assets, if you will, which at the time, there being an insufficiency of safe assets in the view of many people, Wall Street was in some sense trying to construct safe assets through securitization and tranching, and we know that that didn't work out so well. I think that there are some issues with safe assets in that besides collateral, we have potentially increased liquidity requirements, increased margin requirements, and that may create some pressure on the supply of safe assets. At the same time that we're having sovereign debt issues in some parts of the world, which reduces the supply of safe assets. So I think that's an interesting and important question, and one that we have discussed at the Federal Reserve. I would say, however, that I do not think that our asset purchase programs are having a significant effect on that supply-demand balance. And the reason is the very simple point that when we buy assets, and our total purchases, by the way, are a pretty small share of the global amount of safe assets, but anyway, when we buy safe assets, we of course pay for them with bank reserves, which is another safe asset and one that's even more liquid. So I don't think that our asset purchases are significantly affecting the net supply of safe assets, but it is an issue, and one that we've looked at as we've thought about, for example, margining and liquidity policy.
Let me ask about the design of creative policies over the last few years. In the last, say, 5 years, the Fed has navigated a minefield of taking actions that were at the edge of traditional Fed policy, sometimes generating questions about Fed independence and challenges to Fed independence. And of course, central bank independence is a topic that many of the audience members study and work on. Can I ask where you think the greatest threat to central bank independence comes from? Is it from the innovative policies on the macro-prudential side and the dealing with individual financial institutions or the aggregate financial sector? Or do you think it's from the innovative policies on what I'd call the traditional monetary policy side, dealing with the stimulus type role?
Well, that's kind of a political economy question. I'm not sure I can do it justice. Let me just say a preliminary thing, which is I don't think that the central bank should be equally independent in all of its functions. There are good reasons to have independence in monetary policy making subject to a mandate or subject to objectives set by the democratic parliament or legislature. And we all understand those reasons having to do with avoiding short-run political intervention in monetary policy and the like. But in many of its other activities, for example, as a bank regulator, while we believe that bank regulators should be independent to make their own judgments about the quality of banks. I don't think the Fed can presume to be any more or less independent in that function than is the OCC or some other bank regulator. It's just another aspect of our activities. In our provision of payment services, there probably is no real case for independence, and it's entirely appropriate for the Congress to ask questions about what we're charging for those services and how we're providing them and so on. So I think it depends very much on the aspect of the particular activity that the central bank is involved in. So independence is a subtle concept. I think what it means varies according to the particular activity or particular function. There's always, so if we're worried about independence, the place where all central banks worry about independence is mostly in the monetary policy side. And there, I think the best we can do is to do our very best to meet the mandate that Congress has given us. If we don't meet that mandate, then they would have, or if we don't meet it and can't show why we didn't meet it, at least, they would have a reasonable basis to ask why. So I think in the long run, the best thing we can do to maintain monetary policy independence is to show that we will take all reasonable measures to meet the objectives that the Congress has set for us. And of course, that's what we intend to do.
Okay. Shifting from the domestic pressures to the international pressures, some have argued that in the last few years, the policies at the Fed and those of some of the European Central Bank have risked igniting a currency war of sorts. I'm curious as to whether you view that as an inappropriate argument, it's simply wrong, or whether there's some validity to the worry, but it simply was a cost that had to be borne as a consequence of other objectives that the Fed was trying to achieve.
Well, I gave some remarks on this at a London event for Mervyn King's retirement, and appropriate of today's discussion, I used historical example. I made the distinction of during the 1930s, during the Great Depression, as countries left the gold standard, their currencies temporarily depreciated relative to other countries, and they had a temporary trade advantage because of that. But over time, as all the countries left the gold standard, exchange rates kind of normalized, kind of went back to where they started from. But nevertheless, the whole world was nevertheless much better off because there was a global monetary expansion which was desperately needed at that time in the 1930s. So that was a positive sum game. It was a situation in which everybody gains because the benefits of, in that particular context, the benefits of growth-enhancing domestic policies spilled over into other economies. I contrasted that with the Smoot-Hawley tariff, which was more of a zero-sum game, where or even negative sum, because what was going on there was that each country was trying to divert trade in its own favor at the expense of its trading partners. And as that activity continued and reprisals and payback continued, actually it destroyed the global trade pattern and was very costly to everybody. So what has this got to do with your question? I'm sure you're wondering. What it has to do with today is that it's one thing to use trade or other kinds of interventions to to artificially weaken your currency or otherwise to divert exports to your own producers at the expense of other countries. That's a very different thing from a situation where countries are using monetary policy appropriately to achieve domestic growth, domestic reflation, and that growth spills over and helps the economies of other countries as well. So I think that's very much the difference, that the exchange rate effects and the currency effects are really secondary. What's important is that each country provide the necessary monetary accommodation or fiscal accommodation to achieve to achieve its potential output. And this, I should say, this view is not just my own. I mean, this is a view that's been adopted by the G7 and the G20 as a reasonable way of thinking about policy in different countries. So in doing accommodative monetary policy in the United States, again, we are very much consistent with that G20 perspective. And I guess I would close this answer by saying if you look at the dollar, it's not exactly falling recently. It seems to be doing okay. So I don't think we are trying to divert exports away from anybody else. What we're trying to do is achieve domestic growth using the tools that we have.
Okay, this next question is going to take you back to in some sense, the historical perspective of your talk. I guess it really has two components to it. The first is, over the first 100 years of the Federal Reserve, do you believe that on balance, the Fed has given too little weight to issues of regulation and financial stability relative to other objectives? And the second part of the question is that in looking at the lessons over this period, there tends to be a focus on issues associated with the Great Depression. In looking at the early years of the Fed, do you think that there are other important periods in, say, the first 50 years of the Fed that can convey important lessons for thinking about current policy?
Sure, there are many interesting episodes. On the financial stability, the Fed, of course, was founded, as I mentioned, the Fed was founded for the purpose of preserving financial stability. It had some success early on. Then, of course, the Great Depression came, and for various reasons, stigma was mentioned earlier, but I think there were other reasons as well, including a lack of sufficiently aggressive policy on the part of the Federal Reserve. The Fed didn't meet its financial stability mandate during the 30s. And I think that was obviously the most egregious example of failure on that particular front. Now, a less attention to financial stability during the period from 1934 until 1980 or so would be sort of understandable because of structural changes and regulatory changes. That was, of course, a very calm period in U.S. financial markets. And as a result, the attention to financial stability became less over time. As Chairman Volcker reminded us earlier, though, it's not just recently that we've seen financial stability issues, the Mexican debt crisis, Latin American debt crisis, the crises of the 1990s, the Wall Street stock market crash, and other events should have reminded us, and did remind us, that financial instability remains a concern, remains a problem. What we lacked, what didn't happen, fortunately, of course, is that between 1934 and 2007, there was no financial collapse of a magnitude that had serious negative implications for the U.S. economy. Now that we have seen that, and as I mentioned in my remarks, that I think is a very important lesson, and the Federal Reserve and other central banks have accordingly elevated financial stability, increased the resources we put into helping to preserve financial stability, and greatly increased the emphasis we put on that particular objective. So I think there was a long period where the Fed didn't pay much attention to it, but it was a kind of an accident related to the fact that we did have a very calm global financial environment for quite a long time. We now know, of course, that financial stability is extremely important, even in advanced industrial countries like the United States, and I suspect we won't forget that lesson for quite a while.
Okay, this is another question which must come from one of our economic historians. The passage of the Federal Reserve Act in 1912 was a substantial political achievement. Given the political tone in Washington today, if the Federal Reserve Act had to be enacted, how do you think it would differ from the existing legislation, and could it be passed?
Well, I'll tell you one thing, there'd be more than one Federal Reserve Bank in the whole western part of the United States. That's my answer.
Okay, on that note, My last question is a legacy question. At some point, and I'm not going to ask you when you think this might be, your time as chair of the Federal Reserve will conclude. Now, I happen to know, and some people here probably do, that you already have a legacy that I believe no other Federal Reserve chairman has, which is that there is an interchange on I-95 in Dillon, South Carolina, which is named the Bernanke Interchange. And I will challenge anyone, even in the economic history group, to find another interchange on the interstate highway system named after a Federal Reserve governor. But all seriously, as you think about the legacy that you will have as a chairman of the Fed, what would you hope the high points of that would be, and where would you like to see people focusing on the contributions?
Well, of course, that's going to be for others to determine. I guess what I would hope to be able to say is